And it's because the opportunity is there, if you know how to value businesses, which most people do not, to take advantage of the fact that the market is emotional over the short term often.
Joel Greenblatt starts his hedge fund, Gotham Capital, which would return an incredible 50% average annual return from 1985 to 1994. Following his success, he would write about his famous magic formula in 3 New York Times best-selling books, including The Little Book That Beats the Market. This is the fascinating story of Joel Greenblatt. We'll first look at his very inspiring background story, and in the second part, we'll explore his highly profitable magic formula and powerful strategies. Lastly, we'll look into his New York best-selling books and philanthropy work. 1957 New York. The markets are down, but Wall Street didn't know this would be the year legendary investor Joel Greenblatt would be born. Greenblatt would study at the Wharton School at the University of Pennsylvania. However, he wasn't just an ordinary young student. At only 24, he joined Richard Zena, who was a value investor, and Bruce Newberg to test their strategy based on Ben Graham's NCAV method, which I'll explain later. As a result of their work, he had insights into the stock market that not even his professors knew. Suddenly, one day, Greenblatt's life would forever change dramatically. His professors were shocked as he published his breakthrough paper, How the Small Investor Can Beat the Market. The paper took legendary investor Ben Graham's approach further by adding the P/E ratio while comparing 4 portfolios from 1972 to 1978. This period had very high volatility, making it a strong test. To pick the stocks, Greenblatt only looked at companies in the S&P guide with market caps over $3 million and names starting with an A or B. After, he picked the stocks from a short list of roughly 750. To sell a position, the stock would have to hit a 100% gain or pass 2 years, whichever came first. Shockingly, all the portfolios beat the market indexes by a considerable gap. However, even more surprising was the fact that with lower P/E ratios, the results were far better. Greenblatt understood market theory very well, but he had a huge problem. He lacked the experience to break into the best financial companies at the time. Determined and eager, Greenblatt would relentlessly pursue his aim of working in finance. Then one day, he finally had the opportunity to join a company specializing in merger arbitrage. Soon after working there, Greenblatt grew a strong passion for the stock market, which made him want to start his own hedge fund. But how would he start without much experience, and what strategy would he use? He was confused and frustrated. He didn't give up, though, and continued to network with wealthy individuals such as Michael Milken, also known as the Junk Bond King. After becoming closer to wealthy investors, Greenblatt knew it was finally time to make a bold move. It's 1985. This would be the year Greenblatt's life would massively change as he co-founded Gotham Capital with $7 million, mostly from Michael Milken. But Greenblatt or anyone associated with the fund would never have thought what would happen next was achievable. Over the next 9 years, Gotham Capital's returns would go down in history as one of the best ever for a hedge fund over such a period. 50% compounded annual growth per year. Even after deducting fees, the net return was a staggering 34.4%. Gotham Capital isn't based in Gotham City, but that's a return that even Batman would be proud of.
During those 10 years, we had averaged 50% a year returns before our fees.
To help understand, let's say you put $10,000 into Gotham Capital in 1985. By 1994, it would have grown to around $400,000 before fees, which is extraordinary. But how exactly did he do it? Let's look at his strategy and his famous magic formula, as he calls it, to find out. Greenblatt is primarily a value investor focusing on special situations, which I'll explain more on later. He learned from Benjamin Graham, who also taught the likes of Warren Buffett. Ben Graham had his net current asset value, or NCAV, stock strategy, which was also known as the net investing. To understand Greenblatt's plan, we first need to look at Ben Graham's approach because it formed the foundation for Greenblatt. Essentially, Graham's NCAV strategy looked at stocks trading lower than their liquidation value based on net current asset value per share. Net current asset value per share, or NCAVPS, is based on subtracting a company's total liabilities from its current assets and dividing the result by the outstanding shares. Graham mentioned you want to buy a diversified range of stocks trading at no more than 2/3 of their NCAVPS. Joel Greenblatt became impressed after spending years studying Ben Graham's investing principles. The primary method of Gotham Asset Management is analyzing the value of around 3,000 of the biggest U.S. companies. Greenblatt states, "We then buy the companies we believe are the cheapest and short the ones we believe are the most expensive." Gotham funds are also managed by Joel Greenblatt and Robert Goldstein, who joined the company in 1989. The main neutral fund is Go Knicks, named after the New York Knicks, Greenblatt's favorite basketball team. The Gotham analysts use a proprietary framework to assess stocks with absolute and relative valuations. Greenblatt explains that the company only uses value measures such as PE ratios and return on capital, not momentum or technical indicators. They use cash flow analysis and calculate relative value with past and present data analysis. Interestingly, Greenblatt mentions research at Gotham is a shared job with many checks in the process. Additionally, when there's a change to the analysis of a stock, it gets reviewed on several different levels. Ideally, every company in the 3,000 list of stocks Gotham looks at should be reviewed many times a year. However, some companies are more complex than others, which means they don't have a set amount of time to analyze each company. Also, important company news releases will take priority as major changes to management or earnings will significantly impact the share price. Greenblatt explains how Gotham analyzes companies by looking at how a potential owner would by finding out how much they would pay for equity and how much debt they are taking on. Additionally, they would look at all liabilities, cash flow earnings, and many other metrics before comparing them to other stocks. Patience is fundamental to Greenblatt's strategy, as he says, "If I can't wait for a year or two for the market to get it right, I shouldn't be in stocks in the first place." He believes that if the valuation is accurate, the markets will eventually align to reflect the fair value. However, no matter how correct we think we are, the markets may not always agree. Therefore, Greenblatt emphasizes that patience is key, and it's becoming harder to wait longer as we have more news coverage than ever and apps to check prices many times a day. Ultimately, the most important thing is to stick to the strategy, as he says, "Our secret, if we have one, is that we stick to our guns." You may think it's easy enough for Greenblatt to say that as he's been investing for over 30 years, but he's stuck to a very similar approach for a long time. Gotham uses diversification to help manage risk, and the amount they invest varies based on how illiquid a stock is. With stocks, liquidity simply refers to how easily and quickly shares of a company can be bought or sold without significantly impacting the stock's price. If we look at the Go Knicks portfolio, the biggest position bought is usually less than 1.1% and 0.8% on the sell side. As a position moved towards its price target, they typically sell some of it. The amount sold would then be moved to a company at a better discount for its fair value. Risk management for short positions is not the same as for long positions, because shorts have the potential for unlimited loss. Greenblatt mentions the fund reduces risk when shorting by diversifying a lot and cutting losing short positions. To help manage volatility, Gotham lets their net exposure vary, but not for market-neutral funds. Beta needs to be in a range of plus or minus 0.05 for the entire portfolio. Therefore, when the long exposure of the fund changes, the short exposure changes simultaneously. Essentially, the fund is hedging risk for the long term, and net exposure varies between funds. Greenblatt says, "We don't care about beta on individual names, but when you aggregate the betas across 300 names aside, yeah, we do care." Beta measures a stock's volatility against the market. Many investors use the S&P 500 index as a base market measure, which has a beta of 1, and stocks are measured based on how much they vary from the market, with above 1 being high beta and below 1 being low. But what separates Gotham from other hedge funds? The answer partly comes from their deep analysis of financial statements such as balance sheets, income statements, and cash flows. They inspect every tiny detail. For example, what's that deferred tax item, or what reporting period write-offs belong in? Gotham analysts do not rely on stock screeners. Instead, they go to the actual company statements for a deeper analysis. Aside from analytics, Gotham has a technical team that does trade management and risk management, which allows for the portfolio to be run properly. But there's a major problem with Greenblatt's fund. Like most value investors, how do they avoid a value trap? Basically, a value trap is a stock that looks cheap based on popular valuation metrics, but fails to perform due to underlying fundamental issues. The answer comes from looking at high-quality companies that manage capital efficiently. It's not simply a case of finding the best value stocks, but rather finding value plus buying a good quality company. Buying higher quality companies and not just the best value ones was something the late Charlie Munger helped Warren Buffett with, and Greenblatt aims to follow in their footsteps. The strategy is unique as it's based primarily on value investing and taking on special situations like spin-offs and mergers while using leverage. Don't worry if you're confused. We'll go through what each one means in detail so you can understand it better. Value investing essentially means buying stocks that seem to be trading for a lower amount than their intrinsic or book value. Typically, it involves using fundamental analysis. Special situations can include mergers, restructurings, and spin-offs. Greenblatt is looking at these types of events to profit, particularly when companies are going through major transformation. He believes these events frequently cause mispriced stocks as the market was too slow to assess their impact on a company. It's fair to say Greenblatt popularized the value of special situations. Let's take a look at some examples of special situations. Spin-offs are when a company puts part of its operations into a new entity and gives shares tax-free to shareholders of the parent company. The amount of shares the shareholder receives is based on the shares the shareholder owns in the parent company. The spin-off can increase the value for the new entity, as it may do better on its own rather than being part of the parent company. Despite being highly profitable, spin-offs are a small part of the Gotham strategy. The reason is partly because a spin-out might be around 10% of that company's market cap, which can often be too small and illiquid for a fund like Greenblatt's. Next, we have mergers and acquisitions, which are different ways companies can combine. Companies can acquire part or all of another company's assets, which is typically financed through a combination of debt, cash, and stock. The M&A can significantly change the structure and financial situation of a company. Greenblatt would look for opportunities where the potential impact from the M&A may not already be priced into the stock. Bankruptcy is when companies or individuals can't pay their debts, and it's a popular opportunity to profit for hedge fund managers like David Tepper, for example. Feel free to check out David Tepper's fascinating story and how he profited from special situations here. Both Greenblatt and Tepper look for companies with financial distress or going through debt restructuring, as they can occasionally give great opportunities to profit. However, these scenarios are high risk, and a specialist's knowledge of bankruptcy laws is essential. It's definitely not one for the novice investor, as deep research into whether the company is moving towards a better position after reorganization is required. Common risks include previous issues resurfacing and so-called vulture investors that purchase stock during bankruptcy and sell it soon after the company recovers. Lastly, we have share buybacks or special dividends, which are common ways shareholders can benefit. Companies can buy back stock from a market to decrease the amount of outstanding shares, which helps boost the stock price and increase earnings per share. However, a special dividend is a bit different, as it distributes company assets that are usually given as cash to shareholders. It differs from normal dividends, as it is usually a larger distribution and is connected to a particular event. These events create unique opportunities for Greenblatt to profit. So, what were some of Greenblatt's best investments? Interestingly, he profited a substantial amount investing in Michael Burry's fund, Scion Asset Management, before Burry shorted mortgage-backed securities prior to the 2008 crisis. In 2000, Gotham Capital bought around 25% of Scion Capital to help Michael Burry start his hedge fund. Burry's famous Big Short caused panic amongst many of his clients, including Greenblatt, who want to withdraw his money, but Burry had a clause in the contract which prevented this. But Greenblatt would be shocked. Incredibly, Gotham's investment in Scion returned over $100 million with an initial investment of only around $1 million. However, Gotham still withdrew its investment from Scion despite profiting hugely. Special situations made Greenblatt significant profits. However, something else made him a lot more money: the magic formula. But what exactly is his highly profitable and popular magic formula? Well, let's find out. The magic formula has been back-tested to deliver stock market returns that beat the S&P 500 index. It is built on screening stocks based on value and is claimed to return over 30% annually. The formula uses two primary financial metrics to rank stocks and calculate their value to investors. These are return on capital and earnings yield. Together, they are powerful as they help recognize higher quality stocks trading at a discount, which can create greater potential profit. Here are some more key points on how the magic formula works. 1. Work out the company's return on capital by looking at earnings before interest and tax, or EBIT, divided by net fixed assets. 2. Calculate earnings yield, EBIT divided by enterprise value. 3. Rank the stocks by highest earnings and return on capital. 4. Find out the return on capital, EBIT divided by net fixed assets plus working capital. Return on capital helps determine how efficiently a company manages its earnings. 5. Yield based on earnings per share divided by the current stock price. 6. Buy 2 or 3 stocks every month in your top 20 to 30 stocks and repeat this for at least 5 years. Investors can use Greenblatt's stock screener tool to find the top 30 to 50 stocks. It's important to note that the strategy includes large cap stocks over $50 million and not small caps. Also, it excludes non-US companies, financial companies, and utility companies. Bear in mind the tax-saving tactics used with this strategy. Investors sell losing stocks within a year to help offset gains on other stocks. For winning stocks, it's better to sell after a year to use the long-term capital gains rate to reduce income taxes. Rebalancing the portfolio yearly also helps keep your portfolio allocations for each stock as you want. But don't be fooled into thinking it's magically going to make you millions without putting in the work. As with any strategy, it has its disadvantages. For example, it's a quantitative strategy that requires investing for the long term. It can be challenging for those looking for quick results or are easily influenced by market volatility. Greenblatt mentions that the magic formula is not to get rich quick, but rather to use discipline and patience over the long term to profit. Another disadvantage is that due to the changing market dynamics and the increasing popularity of the formula, very similar results may not play out in the future. Many analysts have experimented with the strategy to include other metrics you find valuable, such as dividend yields or debt-to-equity ratios, which can sometimes improve returns. However, the formula is simple and easy to follow for investors at any level. It is based on tried and tested criteria which have given market-beating returns over many years. For example, a backtest from 2003 to 2015 saw annual returns of 11.4% versus 8.7% from the S&P 500. However, that return is not anywhere close to some of the over 30% returns mentioned in the little book that beat the market. If you're interested in learning more about the magic formula, I recommend reading Greenblatt's New York Times best-selling book called The Little Book That Beats the Market. It was published in 2005 and updated in 2010 with the new book, The Little Book That Still Beats the Market. The book includes data and analysis covering the 2008 crisis and model performance through the end of 2009. It gained popularity due to going against normal Wall Street advice and recommends using a simple formula for above-average returns. Its simplicity in explaining complex concepts makes the book unique, and Greenblatt even stated that while it's sophisticated, it could still be understood by his kids. The magic formula strategy is particularly helpful for beginners who ideally want to invest with less emotion and discretion. Additionally, he wrote, "You can be a stock market genius," which was very popular mainly because of its easy-to-understand and unique investing strategies. The book goes into detail on the following investing tactics: spin-offs, restructurings, merger securities, rights offerings, recapitalizations, bankruptcies, and risk arbitrage. Despite having high diversification with Gotham Capital, Greenblatt argues that you don't necessarily need more than 10 stocks. You can remove most of the risk from being too concentrated in a sector with only 10 stocks. As mentioned in his book, You Can Be a Stock Market Genius. When analyzing a stock, Greenblatt looks at criteria such as a relatively low price to NCAV, little debt, high NCAV per share, and stock buybacks, particularly from insiders. During his portfolio tests, he analyzed companies starting with A or B, removing most net stocks. It's not surprising to learn that the portfolios with lower prices to NCAV gave better results than the higher-priced ones. Joel Greenblatt is not just an outstanding investor, he's also a well-respected teacher for over 20 years at Columbia Business School, one of the best business schools globally. He teaches value and special situation investing while giving the same level of clarity and actionable insights from his best-selling books. Additionally, Greenblatt gives students lessons from his highly successful investing experience, which most teachers cannot do. Greenblatt teaches his students that 2 or 3 years is, 90% of the time, enough time for the market to make a correct price of a stock based on its valuation. His teachings also extend into public speaking events where he often mentions that anyone can be successful with the right knowledge. Greenblatt's impressive track record with Gotham Capital, his best-selling books, and his insightful teaching skills means he has a powerful impact in finance. His unique approach to special situations and the magic formula make his story truly unique. Greenblatt has simplified his strategy so that the average retail investor can easily understand. He believes that patience, discipline, and the right investing principles can lead anyone to beat the market. However, Greenblatt is not without his critics. Several studies have shown Greenblatt's formula to outperform the market average, but this is not without much higher short-term volatility. Due to his fairly concentrated approach, following his strategy can lead to sharper drawdowns. Gotham Capital was closed to outside investors from 1995 to 2009. Despite this, according to AUM13F.com, the fund has $6.3 billion of assets under management as of 2024. That's really impressive. His core principle of using 2 key ratios, return on capital and earnings yield before interest and tax, is fundamental to his success. A high return on capital means a company makes good work of its capital, while a higher earnings yield means a company might be undervalued. It is also important to understand the importance of having a long-term view when using Greenblatt's strategy. He talks about a fascinating story in a book he read called Astroball. The story is about the Houston Astros, the worst baseball side in over 50 years. However, despite this, they shockingly said they would win the World Series in 2017. And you know what? The Astros went from being the worst team to the best and did win it. They did it by focusing on long-term goals, as they could not afford the best players at the current time, but they could afford the players who could be the best in 3 years. The Houston Astros bought the best prospects, and after remaining patient for many years, it eventually paid off big. As a result of his great success, Greenblatt's net worth is estimated at around $500 million. With 3 best-selling books and a consistent track record, it's easy to see why. His best-selling books are You Can Be a Stock Market Genius and The Little Book That Beats the Market. Other notable achievements include being the former chairman of the board at Alliant Tech Systems and founder of the New York Securities Auction Corporation. Also, Greenblatt was a director at Zena Investment Management, which specializes in value investing and has over $58 billion in assets under management as of 2024. Hey, if you enjoyed the video, feel free to click that like button because it helps. I make videos explaining interesting financial stories, so make sure you subscribe so you don't miss out. Check out more stories here. Thanks.